With the extraordinary volatility on world markets, financial advisors to leading institutional investors must be coming into their own. One such firm, Towers Watson, is a global independent, itself listed on the New York Stock Exchange, with funds under advice of over $2.1 trillion for clients like top sovereign wealth funds and super funds. A Hess is Towers Watson's global head of investment based in New York, but he also travels regularly to London, which is where I caught up with him earlier. A Hess, welcome to the programme.
Thanks very much, Tiki. Pleasure to be here.
Now, Nouriel Roubini has recently talked about the likelihood of a double-dip recession in the US. What are your thoughts and whether it might go global?
We do have fears that a recession is indeed a possibility for the U.S. Nothing very good has happened to the consumer recently. Jobs have not ticked up. While businesses are sitting in a lot of cash, government austerity, I think, represents the most recent threat. That's likely to remain localized to the U.S. economy, but clearly other governments may be feeling the pressures as well. So we will have to see. It's a real threat.
We had a pretty strange day on the markets today, and indeed in Asia, the markets coming back late in the day. There was some suggestion that there might be a whiff of QE3 about. Do you think that's likely, and can the US afford it?
Well, whether the U.S. can afford it and whether the U.S. will do it are actually different things. Yeah. It's unquestionably so that the Fed feels some obligation to protect asset values. Whether it can actually accomplish this in the face of a rising sea of pessimism is another story altogether. So I wouldn't advise everyone to start buying on the dips just yet.
You're in a very unique position advising sovereign wealth funds and they're very, very big institutional funds. What are you telling them about their investments in equity at the moment? Sell down or sit tight and wait?
Well, we do think that while equities aren't quite cheap yet, they are certainly cheaper than they used to be. So for those who've got a bit of dry powder yet, it's starting to look a bit enticing. That being said, this appears to be a very momentum-driven market. And, sort of watching as the sea comes in or running for the hills, well, that's a decision individual investors are going to have to make, yeah.
I see overnight the G20 talking about coordinated initiatives, financial stability, that sort of thing. But could that extend to pressure on sovereign wealth funds to perhaps invest and support the equity market?
It's possible, yes, but again, it's not as if there's a club of sovereign wealth funds we can just go knocking on the door of. So you're a bit sort of canvassing who's got some pressure that they can bring to bear. It's much more likely to be governments and then indirectly sovereign wealth funds than direct support by those funds.
More long-term, from an investment point of view, you see a serious increase in sovereign risk emerging in developed countries. Why is this?
Because these countries have overextended themselves. If you look at debt-to-GDP ratios, they're sharply higher than they were a decade ago. And given current spending policies, they're projected to get still higher yet.
So do you, for example, worry about France and Germany and the extent that they might go in and further try and bail out other parts of Europe, and that might affect their rating?
There is going to be some downward pressure, yes, if the economics play out. The political risk, which I think is what S&P really did to the U.S., don't appear to be there yet. But, as I'm in London right now, and we're seeing some fairly interesting activities on the streets of North and South London the last couple nights, whether that sort of political unrest spreads to the center of the EU rather than the periphery, I think is the big question with respect to that sort of.
Well, I was going to ask you, there are the British leaders coming back early from their holidays. To what extent might this impact their view on the austerity package and whether they should perhaps take their foot off the pedal on that?
Difficult to see. The bond markets would punish that, I think, fairly heavily. You might see a bit of redirection of spending to the extent we have sort of less of a global war afoot in various jurisdictions. There should be some money freed up. That should be a bit of a tailwind for the U.S. as well. But, we'll have to wait and see. Yeah.
The world growth story seems to be in for a bit of a bashing as well. What's your views when it comes to investing in countries like India and China now?
Well, I mean, these are economies that don't face the headwinds of the developed world. And so we think they are a stronger proposition on the fundamentals. That being said, every investment has to be taken on individual merits. In addition, you've got to be concerned with the flow of funds, right? So the Chinese market has been known to bubble from time to time. As a result, when you invest can be as important as what you invest in.
And indeed, they're very dependent on Europe and the US for their economy, aren't they?
Well, Chinese are becoming, ever more an internal economy. I mean, while certainly it's export-driven, the buildup of Chinese infrastructure has been designed to sort of replace that export-driven economy with an internal one. I mean, I think it's an explicit goal of the Chinese government.
Can they go it alone, do you think?
No one gets to go it alone, but you can certainly kind of come to the front of the fray and be less reliant on others. That's I wouldn't bet against the Chinese.
Carl Hess, interesting advice for the end of our interview. Thank you so much for joining us.
Always a pleasure, Tiggy. Thank you.